Welcome, everyone. Thank you for being here. This is Growth Friday. We want to welcome you to a discussion that would be useful to a lot of you in reference to financing. Growth Friday is a session that is offered to you every Friday or most of the Fridays. If we have not met yet, my name is Brenda Kasuva. That's my contact information. If you haven't scanned the QR code for you to be able to connect with us, go ahead and take that opportunity at the top right-hand side to scan our QR code. Otherwise, some of us can just easily take a picture or connect with me on social media if you haven't already by going to find me with my first and last name, Brenda Kasuva, or Training with Brenda. We do have courses available now. When you go to our website, we have two. One is the conversation of creating Google Forms, and the forms are useful when you are working on a buyer consultation. Prior to that, maybe getting some of information from the buyer or the seller or a open house. If you're doing an open house, you can create a form, have it on your tablet, how you're able to do that. And in conjunction, connected with a QR code, such as the end point of this is that you have a QR code, somebody scans it, they go to your Google form where you're asking them to fill out information, and you have the information collected right away. So that is all available by you going to our website, brendakasuva.com. Presented by Kyle, our guest speaker today from First Home Mortgage. And this is a guide or template. Let me open it up on a larger view for some of us. So here is the reference point for us as real estate agents, kind of guiding us on loan limits when you're talking to some of your buyers when they're considering to purchase a house, dependent on the type of a loan that they're going to use. This is where it breaks it down for you for the conventional FHA and VA. On the right-hand side of that particular document, the down payments presented there. They do have a product that gives the person an opportunity to do 3% on a conventional loan. Education on closing cost and what is paid up front. And then his contact information, which I'll be displaying as well when we do the session. VA funding fees is going to go deeper into that today. Maximum seller contributions when we get to that type of a market. When you're asking for seller contribution, what are the maximums? That's all presented in this particular flyer. And on the left-hand side, one that I'm going to be talking about is when you are looking at the FHA financing addendum, and they're asking you to put in some numbers. This is where you're able to get your cheat sheet there. We're definitely going to cover that. So this is a 2-page document. Let's continue this conversation and get started on what you're here for in terms of the topic for financing. When you're presenting an offer, your mentor, your broker has guided you on a couple of things. You should have already had a conversation with the lender, hopefully prior to you starting to show the houses to the buyer. The buyer should have already connected with the lender for them to have an idea as to how much they qualify for, and also the type of property is sometimes related to the type of loan that they're able to get. Today, we're just focusing on the 3: conventional FHA and VA. There's the USDA loan and many other types of loans that are out there. Here's where we start off with a conversation with the loan officer. Kyle Davidson is with us today. He's with First Home Mortgage, and he'll be feeding us information that we should be aware of as we're working with our buyers. He is flexible in terms of location. Even though the main office, just like a lot of us, you have your main office somewhere, but you can do business anywhere. He's able to meet you virtually, face-to-face, and also in other locations for the first home mortgage. Kyle, you want to say hi now, or yes, why
Yeah,
don't
I
you?
can introduce myself.
Yes.
Well, hello, everyone. Thank you so much for having me, Brenda. So as she said, my name is Kyle Davidson. I'm a loan officer with First Home Mortgage. First Home Mortgage, we're actually the top purchase lender in the state of Maryland. So we do a lot of, I think we do about 10% of the business, purchase business in Maryland. So we have a very large regional presence, which is obviously very important for getting your offers accepted. Listing agents in particular definitely want, a name that they know on the other side of the pre-approval letter. If many of you probably have worked with like an online lender, and it's very difficult to get in contact with someone. That's something I definitely stress is communication and making myself available 7 days a week to answer any questions or concerns that might come up.
The terms and conditions of the contract feeds us with the question mark. Right on page 1 is where I'm going to start off with. I am definitely biased and using the Maryland Realtors one. Your broker might have formulated one, but since we are 30,000 of us that use the Maryland, that are members of Maryland Realtors, that's the one that I'm going to use for today's discussion. Please note that there's no standard contract in Maryland, meaning that this is only available to the members of Maryland Realtors. If someone is not a member of Maryland Realtors, then their broker and their attorneys have created their own. I am using this today as our template. So just wanted to make sure that disclosure is out there. On page 1, we shall just be focusing on number 9 and 10 and a little bit on 11. They're definitely continuing education classes that feed into that particular conversation. Your broker, your team leader, and your mentor also are available to guide you on everything else that is in that particular contract. So we start off with number 9, the financing, and this is where the communication between you and the lender helps, because the process is usually what? The buyer found the house, they liked it, you're now helping them in compiling the offer, you did a market analysis, and then you compiled the offer, presented it to the other side, listing agent provides that information or forwards it to the seller. There's discussion, and that is why the education is good for you when you're on the buyer side, but also good on the listing side, because you're also educating the sellers as to what they are receiving. The first conversation as to where the money is coming from starts on paragraph 9, which is talking about how you're going to purchase this house. Now, financing, again, there's some of us who are fortunate or at that bracket where they're not borrowing money from the bank. So then you have those options on the right-hand side, no financing or other, and you're able to fill it out there. And then you have on the left-hand side, the 3 that we're going to be focusing on, the conventional financing, the FHA or VA, and you're checking off the boxes. Sometimes you're going to check off more than one. Sometimes you have somebody who's getting the FHA, and then within that financing or the purchasing of the house, let's say there's someone else who's going to contribute towards the purchase. They're using a grant, they're using a home product that is specific in that particular area, like Baltimore City or Baltimore County, or they're using the Maryland mortgage product. Then you're going to put in that indication in the other box to let the seller know that, yes, the buyer is going to be doing a conventional loan, but they're also dependent on this money from someone else. So that's going to be disclosed there. If you're ever going to have money coming as a gift with conversation with Kyle, the lender, you are also going to check off the gift of funds, and Kyle is going to direct you on that. For today's focus, since we have an hour, we're just going to go on the 3. Here we're just doing brush strokes as to what is presented here. Conventional financing, FHA financing, and VA financing is what we're going to get into. You'll check off the box as applicable, and you'll have in conversation with the lender to know which type of a loan it is, and you're probably looking at the pre-approval letter. So 10 is where we're filling out the financing part of it. The first box, if I summarize it for us, is going to talk about the written application. Written application. How much time is my buyer, and let me just pick on someone, Ayana, going to spend or have to do a written application? So Ayana has found the house. We're now putting in the offer for Ayana. Ayana has connected with Kyle. We have the pre-approval letter. So this part here, we're filling out how much time is she going to put in a formal application, because Kyle needs the offer signed and initialed by both parties, sellers and buyers. And then he needs to have all the other documents, if he doesn't already, the bank statements, etc. How many days from the contract being accepted is Ayana going to put in that written application? Kyle, the lender, buyer agent, and buyer Ayana need to all be in communication to make sure that this is done within that time frame that you put there. Why? We are under a time is of the essence clause. So if we have Blanca, the listing agent, representing the seller, checking in with Kyle, the lender, to see whether the application was done, and Ayana, the buyer, hasn't done that yet, then now, Ayana, we might lose dibs on this particular property. Why? Time is of the essence. We put 3 days here from the time the date of contract is accepted. Ayana, you and Kyle need to link up for you to be able to put that written application within the days provided here. And then fast forward, Kyle is going to do his thing along with the loan processor, along with the underwriter. There are a couple of people working behind the scenes on that side. And so fast forward to now the financing, written financing commitment. So this is where Kyle has checked out everything that he can, Ayana, about you, your money, your credit, your income, who you owe other debt to, and so forth. And so now here's where First Home Mortgage is confident. I normally say about 90% confident, because there are a couple of things happening before you get the keys, Ayana. So this is where we're putting in roughly how many days from the date of contract acceptance do we think First Home Mortgage is going to have this stuff together for our buyer, Ayana, to close on the loan and get the keys to the house. So the first blank, application. The next blanks in terms of days is normally as close as possible to your settlement date. So as close as possible to your settlement date. So if you put 30 days for settlement, then the financing commitment, I'm hoping I'm going to get it within 25 days, 27 days. Now, remember, there are always conditions that the buyer, Ayana, needs to meet in order for her to get the loan and the money transferred to the title company, and the seller gets that money, and then Ayana gets the keys. So here, please, it is, I don't know, Kyle, if it is even possible that a buyer puts in an application and gets a financing commitment and it's the same number of days. I don't know if that's possible, but you can correct me.
Brenda,
Yes.
what if they already completed the loan application?
So Kyle, guide us on that, because the loan application, to my understanding, I'm not the expert here, that's why we have Kyle, normally needs the sales contract and a property attached to it.
Yeah, that's pretty accurate. So we obviously do a lot of the back end stuff up front when we're pre-approving the client. So we get, we're basically doing, call it a pre-underwrite. We want to make sure that we have 99.9% certainty that everything is going to pass by the underwriter. So basically what we'll do is we'll run it through an automated underwriting system to make sure that all the major factors are there. But we don't have a property address yet. It's a TBD, to be determined property address. So in order to have a application, we have to have that in the accepted contract. And from there, we'll actually just put the address in, and obviously the interest rate can change. So at that time, the borrower will also lock in their interest rate, at which point it will not change for the duration of the time until closing.
Got it. Thank you. So I guess general rule of thumb is to put 3 days for the application. I've never done it that way because I assumed it was already taken care of when we got the pre-approval letter.
Yeah, I mean, typically, unless there's something funky going on where we need to wait, we can get it out basically the same day. But the buyer does have 3 days to sign that initial disclosure, the loan estimate. So I definitely recommend putting like 3 to 5 days in there. Just so you don't get into hot water if the buyer doesn't sign in time.
Got it.
Okay, so the application date, obviously from a listing agent perspective, the sooner that the buyer, who did I use? Ayana, goes and does the application, the better for us to know whether we're going to move forward. So as Kyle mentioned, just to echo what he mentioned, 3 to 5 days, or even some I've put 7, but you and the buyer also need to make sure that you're meeting those dates that you put there. And then the financing commitment, to echo what we shared, is as close as possible to your settlement date, because that's a financing commitment from the lender point of view saying, yep, we're close, we're confident that we're going to give this money to the buyer, Ayana.
Brenda, I have a question.
Sure.
So with this part that you were just going over, now say for instance, if you're doing maybe like a grant program, which takes a little bit longer, do you suggest we do maybe like a 30-day, or is 21 days still would be kind of like acceptable for that?
I think we are now bringing in the conversation of settlement date, right? So settlement date is going to drive the number for how close you are for the financing commitment. I know this isn't a small view, but to answer your question, is communication is going to be the word probably you will hear me reference to a lot today, because every grant or program has its own thing, and how quickly it is done is dependent on buyer, lender, and the who's going to be providing the money. So I don't want to say that all grant programs, it's like, 45 days or 60 days. Each one of them has its own thing. And that's why when you're connecting with the lender, they will normally guide you. Kyle will guide you on what is reasonable, because even if they don't have a grant program, and this happens to me with Kyle, where I was pushing him just last week, where we were putting in an offer and we wanted to settle the end of the month. And I knew I was pushing Kyle, and the buyer is not doing any product at all. And Kyle was like, 2 weeks, we can try 2 weeks, but we want to have a little bit of time because there's so many people involved in this. Are they doing a home inspection? We need the input of appraiser schedule. We need and the underwriter is not just going to look at Brenda's file because Brenda knows Kyle, right? So, and then we have the title process. So the time frame communication is with the lender.
Okay.
Yes.
Thank you.
You're welcome. We then go to the conversation of number 11. Briefly, number 11 of the sales contract does prepare the buyer for, we always want the individual to shop around. So when people are shopping around, we do want to encourage them to shop around as much as possible prior to the offer being compiled and presented. However, they might still want to continue shopping around and comparing with different lenders, which is okay, because then Kyle is able to match or beat what it is that they found. So number 11 gives the buyer to continue that process if they wanted to. However, it is very clear that it's not going to impact the settlement date, and you're not now turning around and asking the seller, let's say, for additional money, and it has to be disclosed. So if the buyer now decides to switch around to conventional or conventional to FHA or VA, for example, that needs to be communicated, because sometimes it warrants for an appraisal to be done. And is the seller willing to make the necessary things for the lender required repair? So anytime there are big significant changes to the financing, with, again, communication with the lender, that will need to be disclosed. We are now on to the addenda. So we've covered, hey, seller, buyer is using this type of a loan, conventional FHA or VA or all the others. Now we need to include that particular verbiage to talk to the seller about. There are times when the person is not dependent on a lender and they're going to have their own money in their bank account, but they still want the property to appraise. So we're going to use the cash appraisal. Some care, some don't. Conversation is key between you and your buyer and the lender, if applicable. Sometimes the buyer needs to sell their house in order to buy this one. So we're going to include that particular addenda. For today's discussion, those are the only two that we are talking about, or rather three. When we get to that market where we're starting to see short sales coming back, then we might be including those addenda as well. So for financing part, this is all going to depend on the conversation that you have with your lender, the type of property, but those are the additional right now that are applicable to the financing side. Once we've selected that, then now we go to the library, and now we're looking for the addenda. So we've addressed the application deadline and commitment from the lender. Kyle, once he receives that particular file, they're then going to order the appraisal. And I'm sure Kyle will add on some feedback on the appraisal side. We do need to share about grants or gift. We've talked about the alternate financing, and we shall definitely address in conjunction with the appraisal, if we get to that point where the appraiser doesn't agree with us in terms of the sales price, and then some of the stuff that might need to be fixed in order for the financing to happen. So Kyle, you want to talk about any of that stuff right now?
I can discuss the appraisal. One thing I would like to mention is with conventional, we don't always necessarily need an appraisal. We can get an appraisal waiver sometimes when we're putting more than 10% down. Sometimes the bank will, the underwriting service will allow us to continue forward without the appraisal, just because they find that it's not risky in that sense. So that's definitely one of the benefits of conventional, because for a number of reasons. One, we don't risk it coming in low, and two, it allows us to close much quicker because we're not contingent on waiting for the appraisal to be done, which can take a couple weeks.
That's if the person has put 10% down.
It's not a complete science, but 10 to 20% is much more likely, but it can happen at 10%.
Okay, so that's where when we hear waiving appraisals, that's possible, obviously based on the higher down payment, because it's less risk for you, the lender, on the loan. Thank you for sharing. And then in this market, probably 2 minutes or so, the conversation of how quickly the turnaround is from the moment buyer Stacy submits an application. Usually the lender and the buyer and the agent are in discussion in terms of, do we wait to order the appraisal until you've done the home inspection? I'm just throwing it out there. Sometimes the buyers will say, you know what, I'm more focused on the appraiser because the appraiser is the final say. So sometimes that could be ordered first. You need to be in communication with the lender if that is the case. But majority of the times, the lenders are waiting for us guys with the buyers to do the home inspection, get that out of the way before they order the appraisal, because these are two expenses that the buyers will have to pay up front. So if we go to the conversation of appraisal, what are you noticing in terms of the turnaround for appraisals coming back to you in this market?
Yeah, so typically I would say 10 to 14 days. They have been a little bit quicker recently because of the interest rates going up. Has, there's basically half the transactions there normally were. So appraisers are a little bit quicker in that sense. So typically it's kind of a case by case, but typically we will wait maybe a day or two after to order the appraisal. And then we can always rush an appraisal. I've actually had appraisals come back over the weekend. I've ordered them on Friday and it be done on Saturday, and then we closed on Monday. So it's not like we're screwing ourselves with that 14-day time frame. But at the same time, I have had it happen where the buyer took too long to back out of the deal, and the appraisal was completed, and now they're on the hook for that $700 for the appraisal. And it was because they were fickle, but at the same time, we had to keep things moving forward. So, so that's what we're trying to avoid.
Yes, so definitely if you're going to hear this word again, communication with the lender is key, because sometimes the buyers think that agent and lender spoke, that they don't share. So we as the agents are the one to be proactive and be checking in with the lender. I am speaking also to some of you who are the listing agents. You're also doing your part in order to make sure you're looking out for the seller, and you should be checking in with the lender as well for them to share with you what's going on. They're not going to share, obviously, the financial stuff of the buyer, but just to give you an idea of where we are.
Somebody was asking me if there's an extra charge for a rush appraisal. There is a little bit of an extra charge. I think it's like $100 to $200, just depending on the type of appraisal.
Okay.
Appraisals typically range in like the $600 range now. As far as when it comes back, so you're asking if there's a discrepancy in the value? Yeah, I always explain this to my borrowers as well. There's really four outcomes that can happen. The seller can make up the difference and just drop the purchase price. The buyer can make up the difference, and sometimes they will say that in their offer right off the bat, that they'll make up, up to $5,000. So that just takes out some of the negotiation time. And then the third is, either party has a chance to walk from the transaction if they don't like it. And the fourth and the most likely is that, there's some compromise in between. Usually, I've actually never had a deal fall apart to a low appraisal. We've been able to get them all worked out, because a lot of times the seller realizes that unless they get a cash offer or just, get a different appraisal value, they're going to deal with the same thing with every single buyer in the future, especially with FHA, since the appraisal stays with the property for 90 days. So they're incentivized. I actually don't mind it, because I think that the buyer usually gets a little bit better deal when the appraisal comes in a little bit low. Of course, it is risky in that they do have the chance to walk, but most of the time they have incentive to get things worked out with you.
Thank you. And the verbiage that we're going to see on our side for the real estate agent side is on the addendum, what he just spoke about in terms of the appraisal contingency. I'm looking right now as the conventional one. It's going to be very similar on the FHA one and the VA one, to where he spoke about it's contingent on the buyer getting an appraisal. And if it is less than, then this is where we have those things applicable here. You're filling out how long do we have to negotiate? 2 days, 3 days, 1 day. In terms of if your buyer got the appraisal, you're going to share with the listing agent the outcome. And sometimes here's where listing agents might want to ask for proof. And this is two schools of thought. Your broker will be the one to guide you finally on the outcome. Is some will argue that the appraisal report technically was paid for by the buyer. Buyer needs to give permission, even though technically it belongs to the lender. That's why the lender gives it to the buyer, and then it's up to the buyer to send it to us. So by us sharing it with the listing agent, there needs to be conversation with the lender and the buyer. And then sometimes you can just send the first page that has the information produced by the appraiser to show them proof in terms of how low it came. This conversation ties well with any requested lender repairs as well.
Mm-hmm.
So there are times when the lender will not give the money because the appraiser said that there's certain things that need to be fixed. So in the addenda, whether it's the conventional one or FHA or even VA, there's usually going to be a spot that talks about lender required repairs. And I'm tying in both conversations together, and hopefully I'll do a quick review, is where you're going to put a number as to what you think it's going to cost. Now, this is where schools of thought, some have heard 500, some have been 200, some have been nothing, some have been 1,000. I welcome any feedback as to what number you have used there. However, in the end, what we are talking about is what we think the cost of the repairs are going to be. And if we lose the mark, if you're not close to whatever the amount is that it's going to cost for the repairs that have been requested by the lender, then you have the 4 options addressed here. Seller is going to pay it no matter what it is. So if I put 500 and the costs are going to be 800, option A, seller is going to cover all the way to 800. Or B, you know what, it's going to, here's the estimate, it's going to cost 800. Buyer, do you want to pay the difference? So $300 extra from the buyer. And Kyle might talk about whether he wants to know that's happening. I guess it's okay because it's lender required repairs. Or, you know what, $300 is too much for me, buyer, I'm walking away. So it's still addressed in terms of what happens if your number here is now the repairs are going to be higher. If you want to add on to that part, Kyle, feel free.
Yeah, I have had the buyers actually do all the repairs before. It's not really an issue. I definitely recommend against it because I think that if the buyer, if for some reason the deal falls apart, which it's, I think, more likely to, this particular case, they were actually doing the repairs before the appraisal was done because it was an FHA loan and they were expecting it to come back with repairs. And in this particular case, it actually all worked out. It didn't need any repairs. The appraiser was good to us. But in a not so ideal world, they could have just been out of all their expenses and time of fixing that up if the repairs or the value came in significantly low or the repairs were astronomical.
Excuse me,
Thank
Brenda.
you. Yes.
Hi, it's Deidre. Sorry, I'm off camera. But I put it in the chat, 2 things. One with the VA. The VA does not allow the buyers to fix any repairs.
Right, Deirdre, give me 2 seconds, give us maybe 3 minutes. Let's finish because we're gonna talk about VA. Yes, yes, if you don't mind.
Oh, no, not at all on that. And then I was just also asking that from Kyle in the sense of what I've done is have, instead of having the buyer pay for the repairs immediately, sort of place it within the closing costs. So the sellers are repairing it. And then that reimbursement goes to the closing costs. I don't know if you want to speak on that to see if I'm
Okay, I
doing that
see
right
where
or
you're
wrong.
coming from. Yeah, so that was, thank you for that. I was gonna ask Kyle a follow-up question, so we're right on the same track. So Kyle, the question I think Deirdre and I are having is, in the scenario where the buyer has elected to do the repairs, they're now fixing a house that First Home Mortgage has not given money to. What's a good picture for you, the lender, in terms of, okay, money came out from the buyer and you guys are looking at the bank statements and so on. I guess give us a clean picture as to, you're hearing what we do on our side.
Or you're talking about for VA or for FHA?
Even conventional or FHA, when the buyer is making the repairs themselves.
Yeah, I mean, I honestly would prefer just not to see any of it. And I definitely don't want the underwriter to see it. I would just tell people, like, you know, have your friends and family pay for it if you're tight on funds to close, or put it on a credit card or something like that.
Yes, so now here's where Kyle is gonna cover his ears, and Deirdre, probably now share your way to address this. I don't want to say your workaround.
Right.
Okay, so
Well,
go ahead.
So Kyle, so my challenge to you is, you know, you're my buyer's lender, and my buyer comes in, and of course he's a VA, and the VA, or even from whether it's VA, FHA, or conventional, there is a credit that is given to the seller at closing. I guess without putting myself in hot water, if you're seeing the credit from the buyer, regardless of the buyer status, whether it's VA, FHA, or conventional, to the seller as closing or additional, you know, paying, whatever the case may be, that is not a flag, right?
So I don't know, that certainly seems like it would be a red flag. What I will say is, if you got some form of seller help from the seller right out the gate and we reduced that amount, that might work.
Yeah.
But I give seller credits to a seller are very yeah, I wouldn't recommend that.
Deirdre, probably reduce the price.
Right.
Yeah, you could reduce the price.
Reduce the price, yeah. So 2 ways is, if there was a seller contribution up front that was accepted by the seller, then now we're reducing that. In this market, Deirdre, reduce the price.
But the VA, the seller, the buyer can pay the seller's closing cost, right? Or
in the VA.
Oh, you're
the
talking
buyer
about the
can give
transfer
credit
taxes, right?
Pardon?
You're talking about the transfer tax.
I'm talking about, yeah, their transfer and
I
recordation
guess that
taxes.
we would have to be careful in how you structured that, but that's certainly a possibility.
Or if the buyer gives the seller $5,000 towards the seller's closing cost.
Yeah, so yeah,
That's
it's
a flag.
you have you have 3 options with the transfer taxes. You can ask the seller to pay the full amount of the transfer taxes. You could usually it's a 50-50 split, and then the buyer could pay all of them as well to make a more competitive offer. So I'm guessing what you're saying is the buyer would just either offer to pay the full portion of the transfer taxes. I could see how that.
I mean, like in lieu of repairs, you know,
Mhm.
I mean,
Yeah, you'd have to get a
contractual wise, if it needs repairs, but the
Yeah.
buyer's paying the seller's
You'd
transfer.
have to hope that
recordation
an
tax.
underwriter wouldn't catch that, but
Yeah, so Deirdre, probably bottom line is, as you buyers, the sellers want to have that in writing, but
Right.
to the lender, you're not sending those documents. And It's not a way that it's a flag that the buyer's contributing to the seller's closing cost. You can definitely work around the transfer cost or reducing the price. To me, I'm making it simple, reduce the sales price. That's me, but
Yep, makes sense. Got
Yeah.
it. Thank you.
you're welcome.
I definitely think that would be a good way to work around it if you really needed to.
Mhm, mhm.
But it really depends on what stage it was in, because we'd obviously, like, you put that on the contract, whether they're splitting the transfer taxes. So we'd basically have to replace the old contract with a new one and hope that the underwriter doesn't ask too many questions about that.
Thank
I got
you.
it. Thank you.
You're welcome. In winding down the conversation of conventional, we have 2-page addendum, and the 2-page addendum, we addressed parts of it. And now we are just reviewing that. If there are any questions, you're able to chime in. The loan amount, all of this stuff is conversation with the lender, and you find it from the pre-approval letter. Keeping in mind, whatever number you put in here as the interest rates, yes, it will change. But in the agreement itself, it does talk about if the interest rates go up, buyer, you're still going to be responsible in terms of that, unless truly it breaks it apart to where buyer is not able to afford it anymore, then that's a different story. So don't be so stuck on, Brenda, what if I put an interest rate here and it changes tomorrow? Yes, it will, because rates are going to change on a daily basis. The next blank on the conventional addendum is a lender repairs. We spoke about that. You pick in a number. We gave you examples and how it is addressed in terms of if the repairs cost more than the number that you put there. And then we also spoke about the appraisal contingency when it doesn't match what it is that you offered. How much time are you giving the seller a heads up and talking about it didn't appraise, or we now need some lender repairs? And then the seller is also going to respond back, sharing what it is that they're going to do. Otherwise, if they're not going to get along, then the people have the opportunity to cancel the contract, and then we tackle the deposit separately. So before we go to FHA, anything you want to add on the conventional side, Kyle?
No, I think we did a good job of covering everything.
Okay. If you feel that we're skimming through this stuff, keep in mind that we do have that resource that is available, and Kyle is also available to continue the conversation. This Realtor reference guide is able to continue that conversation as well. We get into the FHA addendum. The FHA addendum is also 2 pages. Again, conversation with the lender in terms of which type of a loan is going to be applicable. The one part that we slow down a little bit is going to be this part, because some of my friends are usually asking, how am I filling that out? The lender, some of them will put it on the letter, or you can get that number from your lender as well if they did not put it on the letter. Or to be honest, you can go online and search this stuff. The reference guide that you have access to is going to give you the calculations. I'm going to go through it in a couple of seconds. So here's where we're addressing this part. If you want to take a screenshot or go online, you can. So the FHA minimum down payment is 3.5%. There's nothing against Brenda putting more than 3.5%, but that's the minimum. So the base loan is here's where I put it all wrong. Never mind. This is where we're going to do. Oh yeah, I am right, Kyle?
Yeah, you're right.
Yeah. I was like, where's the 175? I'm sorry. Okay, so I started. I'm sorry. This is why the form starts off with the MIP. Brenda started with the base loan, because once I get the base loan, then I will figure out what the MIP is. To some, math is just making you nervous right now, so please contact the lender for this calculations. However, some of us are wanting to know how to figure this out. So first I start off with the base loan. What are they getting from the bank? It's 3.5% of their own money. So they're borrowing 96.5%. So I do 96.5% of the sales price. That's my base loan. Once I have that base loan, then I'm going to apply currently. It is the MIP rate, the upfront premium is 1.75%. So I'm going to do 1.75% times the loan amount, and then I'll have a number, and then I'll add the two to come up with the total loan. Again, your lenders are able to provide you with that information. So that's the first thing that we're going to fill out. Then the next thing is where we're being asked to put in what is the estimated appraisal value. You do want to match what you're offering. So whatever you put on page 1 as the offer price is what you're going to put here, unless what? You have escalations where you're saying you will go up to this amount, and whatever the escalated amount, you do need to discuss it with the lender as well. Anything you want to add on here, Kyle?
That sounds good.
Okay. Okay. And then already in the paragraph, it addresses what happens when the numbers don't match. And what numbers are we talking about? The sales price in conjunction with the appraisal number. Same thing you saw earlier, lender requested repairs, because the appraiser will come up with their own list or not. What is that number, and what happens if that number doesn't match what is required to be repaired? Then that is addressed there as well. I think, Kyle, just in review, could you talk about the flipping rule?
Yeah, so they do have a couple rules in place too. I see you have them outlined here. They do have a couple rules in place. Basically, they're trying to avoid what happened in the early 2000s, where the appraisers were basically just appraising things for whatever they needed. So they'll require 2 appraisals within, if the house has sold within 180 days, and the new price is more than 100% of what the old sales price is. So this is very common with like fix and flips in Baltimore City. Somebody will buy something for $40,000 and try to sell it, fix it up with really quickly and try to sell it for 200. Then we will require the 2 appraisals there. And then on the flip side, you can't like quickly turn around and flip something immediately with an FHA loan. They'll require at least 90 days from the date that the deed recorded. And it's very important that we look up the actual date the deed recorded. Especially during COVID, things got very delayed, and that, we have to go off that deed record date. We can't go off of like the closing date.
And then the appraisal sticks to the property for how many days?
It's 120 days it sticks to it. So actually, if things do end up falling apart because of an appraisal, the next lender that's trying to lend on the property, they actually reach out to us and we transfer the appraisal to them.
Okay. Otherwise, if the seller wanted to get away from that appraisal, they would have to accept a different type of a loan, right?
Yeah, they could go conventional or do a cash, but
Okay.
yeah, it just restricts people from just, not getting the value they want and then just ordering a new appraisal. You have to wait at least 90 days to do so.
Thank you. The other thing maybe we shall just briefly discuss is the type of property. So in terms of condo and or HOA, when you're showing a property that has those encumbrances, connect with the lender as well, because there are some developments where the buyer would not be able to do a FHA loan So that is also a discussion that Kyle is able to check. So what you do probably is when the buyer wants to put in an offer, you've made that connection with your lender, Kyle, and then he looks it up and says, we might not be able to get this one because you're not able to do a FHA loan, right?
Yeah, also conventional has a lot of the same stipulations. A lot of them, if they're not an approved condo list, they will require you to put at least 10% down or get a spot approval. So it's definitely an added layer of complexity to condos, a lot of which is due to that big condo building collapsing in Miami.
Yes. The next type of financing, unless there are questions on FHA and conventional, finding our way to VA.
I have a question real quick, Brenda,
Yes.
for Kyle. Kyle, you said that for FHA, the appraisal stays with the home for 120 days or 90 days?
It's 120 days from the date that it's received.
All right, thank you.
Jamia, the 90 days is the flipping side.
Okay, got you.
Yeah.
I actually had a deal that happened that way. So I found out the hard way, but I know.
If they had it done in the past, like you could get it, like if I had somebody go under contract, I would get it transferred over from the previous lender. It's just we have to use that number.
Okay, got you.
It's not a deal breaker, but.
Thank you.
VA loan is the last one, which not everyone qualifies because they do need to be a veteran or a spouse of a veteran who, if the veteran passed away, the spouse is still with us, they're able to use it as long as they haven't remarried. They do need to have a certificate of eligibility, and they could go all the way to 100%. And we shall be kind of planting the seed here is that they do need a termite inspection, and the seller is the one that's going to be making that particular payment for the termite. VA is one of those that I know the textbook style of it. And so we have one of my colleagues, Amy, that is able to feed us on her experience on the VA side. So Amy, when you're ready, we're looking forward to it. What can you share as your experience here on the VA and the addendum?
So as far as the VA, like the funding fee and the base loan, my go-to is always the lender, just to verify those numbers because my lane, I gotta stay in my lane. So always just verify with the lender, make sure that they give you those numbers just to make sure, when you're presenting your offer is correct, because you really don't want anything wrong on your offer. Loan program, same as like a FHA, to put VA there. Term of loan, same as like a FHA. If it's a 30-year, you put your 30-year, and you also put the interest rate there as well. Similar to FHA, I put buyer agrees to pay 0%, and the seller, I put 0 there for both my VA and FHA.
Right.
The base loan funding fee and loan amount, just make sure you get that from your loan officer.
Yes.
But the VA loan itself, to me, is no different from an FHA. You do have to, the only difference is you do have to sometimes get VA approval. So the VA actually needs to see the contract, and they actually need to verify it with your lender. So that's the only extra step that you may have that you don't have with FHA or conventional. So you do want to give that time, because like any other government ran program, just like FHA or anything that's not just in-house, of course, can take a little longer, because imagine how many VA contracts that they get per day. So give that some grace and some time as well when you're doing a VA loan. But home inspection, nothing is different. Appraisal, to me, a VA appraisal is very similar to FHA appraisal as far as the needed repairs, the pricing and things of that. That's not the same that you're going to get with a conventional appraisal. So they're pretty much kind of the same process to me.
Thank you. So Kyle, you'll chime in to finish this conversation. However, what I wanted to probably chime in with Amy is the fees. So we know that the seller is going to be doing the termite side. And then, and this is disclaimer here, antitrust, so we're not going to give examples on compensation. However, if you're charging whatever you call it, broker fee, extra fee, flat fee, admin fee, what have you, the VA buyer is not going to pay that.
Correct.
Yes. And go ahead, keep going.
Oh, no, I was just going to go back to the termite inspection. I always, whether I'm representing the seller or the buyer and I have a VA client, I just always stress it again to the seller, like that truly is your responsibility. If I have the seller, anytime I see, I'm like, guys, we got to put that, in our budget. And if I have the buyer, I put it in all the emails. Please make sure you tell the seller. Please make sure you tell the seller, that is their fee, just so no one is caught off guard, if it's on like the settlement statement or something of that nature.
Correct. Thank you. Kyle, what can you add on?
Yeah, so I was just going to say that not all veterans will have the funding fee. Disabled veterans will not have it. So you just want to keep an eye out for that. Don't just automatically put in that 2.3% or whatever the corresponding numbers are. Make sure that we are checking to make sure that they're not a disabled veteran, because it benefits them to not pay that, obviously. On the flip side, we order our appraisals through the VA. So the appraisals do take a little bit longer. I would definitely err on the side of 2 weeks for the VA, just because they have usually a little bit different pool of appraisers that they pull from.
Thank you. And to echo what Kyle mentioned is the person who's a disabled veteran doesn't pay the funding fee, correct?
Mm-hmm. Yep.
And the funding fee, for just making it simple, it's similar to the way FHA is asking for the funding fee goes towards the insurance policy to cover the buyer for when we have foreclosure, correct?
Yeah, so it actually protects the lender. The government is insuring the loan. In the case that the buyer does default, they will actually pay basically it's an insurance policy for the lender when they're putting $0 down.
Yeah, just like the way you have protection to the lender with the PMI on the conventional side, and then on the FHA side, you have that MIP. Funding fee is going towards that insurance policy, and that's what the disabled veteran is not going to pay.
Yeah, and veterans don't pay mortgage insurance monthly, so their monthly payments are usually a lot less than the other programs, which is why if you do have someone who's a veteran, they should really consider using the VA loan.
Thank you, Kyle, for being here. And Amy, thank you so much for being here. Everyone else, we thank you for attending. Thank you for watching. You just completed a session that we offer through what we call Growth Fridays. They are offered every Friday at 12 p.m. Eastern. You're welcome to schedule and attend the next session on our website, trainingwithbrenda.com or brendakasuva.com. We have these 1-hour workshops that are available for you to attend via Zoom, walking you through different tools and strategies to grow in your real estate business. Lastly, subscribe for you to be able to get alerts of future videos that we upload here. Be successful. Take care.